China has the world's second-largest stock market, worth over $11 trillion. But for its 220 million investors, it has been more of a headache than a source of wealth. Despite a recent rebound, Chinese and Hong Kong stock markets have lost about $6 trillion in value over the past 3 years, roughly twice the size of the UK economy. This lack of performance explains why households in China have an extraordinarily high savings rate. The country's benchmark CSI 300 index has consistently failed to deliver strong returns compared to global peers. According to Bloomberg, if you invested $10,000 in the US S&P 500 index 10 years ago, today it would be worth over $30,000. But if you put that same money into China's CSI 300 index, the benchmark for its biggest companies, you'd have only about $13,000. That's a huge gap. The US market tripled, while China's barely gained 30% in a decade. Such poor returns have given Chinese households little confidence in the stock market. Instead, they save more and spend less, and that's a big problem for China's economy. To understand today's problems, we need to look at how China's stock market began. The first Chinese securities firm began in 1869, and by the start of World War II, Shanghai had one of the biggest stock markets in the world. But everything changed in 1949, when the People's Republic of China was founded. The government shut down the stock exchange completely as it built a planned economy. For decades, there was no stock market in China. But things began to change with the economic reforms of 1978, when Deng Xiaoping opened up the economy. In the early 1990s, China brought back its stock exchanges. But these exchanges weren't created to make investors rich. Instead, their main purpose was to fund China's development, building roads, factories, and supporting state-owned companies. Even today, many companies on China's stock exchanges are state-owned enterprises that prioritize government policy goals over maximizing profits for investors. This system's weakness became clear during one of China's most dramatic stock market crashes. In 2014, the Shanghai stock market surged, almost twice its value by mid-2015. Investor excitement was so intense that 38 million new accounts were opened in just 2 months. This boom was driven by margin debt and risky speculative trading, creating a classic stock market bubble. In June 2015, the bubble burst. Within months, the Shanghai Composite Index crashed by over 40%. Millions of small investors lost big money. The government tried to stop the panic by halting trading, banning large shareholders from selling, and even using state funds to buy shares. However, these efforts could not undo the damage, and trust in the market collapsed. Even a decade later, Chinese stock indexes still haven't fully recovered. That loss of confidence still shapes how Chinese households handle money today. In the US, people tend to spend more when their stocks go up. But in China, households remain cautious, even during market booms. A big reason is poor stock returns, which make people doubt their financial future. As a result, Chinese families save far more and spend far less. Today, household savings in China total around 160 trillion yuan. That's about $22 trillion, nearly 1/3 of the entire US stock market's value. So, if people don't trust the stock market, where does their money go? Mostly into property. More than 70% of Chinese household wealth is tied up in real estate, compared to only about 30% in the US. This heavy dependence on the property sector, combined with easy credit and rampant speculation, pushed housing prices far beyond what most people could afford, creating a massive real estate bubble. Developers like Evergrande borrowed huge amounts of money to build millions of apartments, but many of those homes are still empty. The company had more than $300 billion in debt, which makes it the world's most indebted developer. It has been formally delisted from the Hong Kong Stock Exchange after failing to provide a viable debt restructuring plan. Today, it still has hundreds of unfinished projects, and creditors have little hope of getting their money back. The stock market's weakness is also linked to China's debt problem. Because equities never became a major source of private financing, the government relied on borrowing, especially through local governments and shadow banking, to keep the economy growing. Today, local governments are burdened with trillions of dollars in debt, much of it tied to land sales and property development. China's stock market troubles have become a serious political headache for Xi Jinping. But this isn't just Xi's problem. For Donald Trump, who frequently targets China with tariffs and trade threats, a weak Chinese stock market also matters. When the stock market fails to perform, Chinese people spend less and save more. This lowers demand inside China, pushes the country to rely more on exports for growth. But at the same time, Chinese consumers also buy fewer foreign products, including American goods. This situation keeps the trade deficit between the US and China wide. In 2024, the US recorded one of its biggest trade deficits with China, around $295 billion. Over the past 5 years, that gap has added up to nearly $1.6 trillion. China's $11 trillion stock market is huge, but it hasn't delivered the returns investors expected. As the world's second-largest economy with the second-largest stock market, its performance matters far beyond its borders. Weak consumer confidence in China can hurt its economy and dampen global demand, from luxury goods in Europe to raw materials in Africa and Latin America.